Well, I guess that over this last week and probably the last month, politics around the globe has really been front and centre. We've seen changes, quite substantial changes in France, in the UK, where the Labour Party had a landslide in the number of seats, but they only really got 34% of the popular vote. And we're also seeing Joe Biden, kind of will he, won't he, be involved as in the presidential race, and what does that kind of mean if Trump has the next presidency of the US? And so some of these kind of big pictures have really been dominating the world of finance, and perhaps looking at trying to figure out what that kind of means, maybe over this next year, kind of 2 years, 3 years, over those kind of parliamentary terms. Yeah, I think sentiment is a very important thing in financial markets. And so, I don't know that there's going to be that much actually happening to influence what's happening in New Zealand. But take the US, for example. What we do know is that Trump will likely have a tariff regime which will impact New Zealand's imports and exports to the US, but also globally as well. And we also know, whether China and Trump, had disagreements, whether that will be ramped up, more into the future. What it also means from a tariff perspective, and we saw that in the last time Trump was there, when he did impose quite a few tariffs, that was quite inflationary for the consumer in the US. And we know that the Federal Reserve and other central banks are very concerned about keeping inflation down. They've been battling that inflation problem for quite some time. So if tariffs lead to higher prices for US consumer and higher inflation, that has implications for levels of interest rates as well. And the higher the level of interest rates are, it tends to slow an economy and also hurt consumers' spending patterns as well. I think the consumer is under real pressure in New Zealand, and I don't know that there's a quick fix for that. I think the die has been set, and it's a process of working through. I think that from the consumer perspective, I think unemployment is going to get a little bit worse, but not really bad. So this recession that we are in New Zealand can be termed a bit of a job-rich recession. So historically 5% unemployment, which is perhaps where we're going to, we're not there yet by any stretch of the imagination, but 5% unemployment is actually still quite a low level of unemployment in New Zealand. So while we have high mortgage rates, and while there is a fear of losing your job, or that you're not going to get, if you do lose a job, you're not going to get another job quickly, that will also be a sentiment thing. It means that people won't be going out spending, won't be going out for meals quite so often, and it kind of feeds upon itself. It's a bit of a negative spiral from an economic perspective. And so I think that it probably won't be until we start seeing meaningful interest rate cuts to mortgages that we actually get a bit of a circuit breaker, and people start to feel a little bit more kind of positive about their spending habits. It's important not to get too much in a pessimistic frame of mind. I think that one thing which we do know is that economies and financial markets go in cycles. Mother Nature goes in cycles. We're in the middle of kind of winter at the moment. We know that spring will eventually come, and just in the same way as those cycles turn over, we are in the depths of a recession at the moment. But just because of that, we know that economic activity will be down. Inflation is rolling over. 17th of this month, we have the June quarter CPI data coming out. That's likely to be lower than where it was this time last year. And so therefore, I think there is kind of hope on the horizon as far as interest rates go. we believe that because of weak economic activity and the outlook for inflation, it'd be very well. Whether the Reserve Bank starts cutting rates in November or in August, next year, as they're currently suggesting, we know that interest rates are likely to fall. It's a matter of when and by how much. We believe that the Reserve Bank should start cutting earlier, as in November. And if they do start cutting in November, we believe that will be maybe a spark for a bit more kind of confidence, a bit more economic activity. And if they start cutting earlier in November, it means that we believe that the cash rate and mortgage rates may come off by approximately 2%. If they wait until August next year, the fall in interest rates will be much more severe, much deeper, but that's because the economy will have had another 6 months or so of being on its knees. And so either way, interest rates are going to fall by a nice amount or a great amount, but fall they will do, and that will engineer a resurgence in economic activity coming out of 2025 and 26.